Welcome to another episode of Bitcoin, Fiat and Rock and Roll. Today again in English because we have very interesting guests here in the podcast for today. And we believe that some episodes at least that require English for the podcast make sense to actually speak English because of the interesting topic. So we have again Stefan today here in the call. Hi, Stefan.
Hi, Manuel. Nice to be here again.
Definitely. And then also we have Martin from Centrifuge, but also from not only Centrifuge, but also Anemoy. So hi, Martin.
Hi, everybody. Thanks for having me.
Thanks for joining, and thanks for joining that podcast and explaining what Centrifuge and Anemoy is doing. So this podcast is really about on-chain funds and on-chain assets, not only tokenized assets, but also natively issued on a blockchain. Money market funds we're going to discuss. We're going to discuss decentralized stablecoins, what the role of Centrifuge and Anemoy is, and what your views are in that respect. So I think it's going to be a fantastic episode. Stefan, I think you're going to lead that discussion for today. So
Absolutely.
I would like to hand over to you.
Yeah, before we start, maybe why did I bring Martin Quensel in here? We got to know each other during our institutional DeFi study that I did earlier this year. And Martin was so nice to explain the Centrifuge universe to me. Later this year, we talked about the use of Centrifuge for a concrete project we were in. So yeah, I was really waiting for the moment to get Martin in here with Bitcoin, Fiat, Rock and Roll, because he's got a lot to tell and he shaped my thinking about on-chain assets. And so I'm very glad to have you, Martin.
Yeah, thank you again. I'm surprised I really shaped your thinking. I think we kind of we're already on the right track, I think.
Absolutely. But before we start into the cool stuff you do nowadays with Centrifuge and Anemoy, please take us back in your personal life a bit, in your professional life. Where are you coming from? I think this helped me. It helped me a lot to understand how you are ticking. Actually, please give us an idea what you have done in the past.
Yeah. Hey, I'm originally from Berlin, grew up in the crazy times when the wall went down. My first job was a software developer at SAP in the 90s. And I then actually started my entrepreneurial career with my first startup around 2000 and really kind of evolved through all these, I would most likely say, software innovation and hype cycles. So when I left SAP, I was involved in the last kind of 1-2 years at SAP with SAP Market. So all the internet marketplace hype of the 2000s and the bubble bursting. The first startup I had was building on-premise software for process automation. And then kind of, grew more and more into finance, but also the other software cycles, from a on-premise software model to software leasing to SaaS and Web 1, Web 2. So I also had a company called Taulia. We sold it to SAP as an SAP brand now. And that was basically a marketplace where invoices available for financing and which was connecting the biggest buying organizations on the planet. Think of an Airbus, a Vodafone, had actually access to all the suppliers from the biggest to the smallest, and all of them had an opportunity to finance their invoices. And in the past, really, that was only available to the biggest suppliers. So really innovating the space there, changing, I think, the status quo was always my mission. And in 2016, I first time really understood what blockchain really means. So I think, Bitcoin was out there for a couple of years. Ethereum was even built 2014, mostly in Berlin, etc. But really, when I understood it was a South by Southwest conference in 2016. And what was really kind of striking me was the programmability aspect, So really unstoppable, decentralized software is something which is really kind of, there's the reason for calling it Web 1, Web 2, Web 3. I think that's really the next version of the internet. And I just wanted to be part of that movement and actually thought finance is one of the first use cases which will be disrupted. And that's why we started in Centrifuge. Very early, there was no DeFi back in the time. That was really in the middle of the first ICO hype, and then kind of, next into the next crypto winter in 2018. But we are still there, being one of the OGs of DeFi and definitely real-world assets. And again, thanks for having me.
Yeah, when we spoke earlier this year, you told me that actually Centrifuge was the attempt to rebuild something similar to Taulia, but on Web3 wheels. Is that still your thinking, or how would you describe the motivation for Centrifuge? Because I find it quite remarkable that you actually you had done it, or you had convinced big players like Airbus. How crazy can you be that you then go back and start all over again? I think very few entrepreneurs would do the same thing again. They might go even bigger or elsewhere, but you again started with such a crazy new technology. So what was going on in your head?
I think for me, the innovation aspect is always important. And I think we started from the learning we had with Taulia that the biggest issue in supply chain finance is proving a transaction. It's not fraud. The invoice is real. The invoice isn't double financed. Anything actually in the supply chain, it could be an order, etc. It could be made up or real. And also that all these networks are basically data silos and be restricted in itself. And that's why you have, especially in finance, no real global database. And one helps actually to kind of support the other. So building a global database first, where blockchain is securing the data, give the data originators still the capability to monetize it, which is today, of course, kind of, the marketplaces, the Amazons for B2B. I could name a few like, Ariba, etc. Taulia obviously is one, and then this global database actually improve the data quality and then make it accessible for finance. I think that will come eventually. A lot of projects been working on that. The wrong assumption I had back in the time was really that this would start on your origination sell side. No, it's actually starting on the buy side, So where we see tokenization, blockchain technology really disrupting finance is not how we manage assets. And that was and is still Centrifuge's mission. We can dive a little deeper on that. It's really basically just turn something into a token and give that token a utility. That's what we are seeing right now. And that was something that I most likely had to learn that, and get through the journey over the last few years.
Okay, but maybe dive a bit into Centrifuge. So if you could use a few sentences to explain the main features, the main proposal of Centrifuge to its users.
So first of all, I think important, Centrifuge is a DAO governed through the Centrifuge token, CFG, and that protocol living on its own blockchain, but also connected through bridges to other blockchains. I can talk about that a little later, is actually enabling tokenization use cases for private credit in the first case. So what we did really in 2019, being the very first one tokenizing private credit, bring that on the blockchain, connected to Maker, use a stablecoin to finance that. But it's also very well solid use case for everything else you would like to tokenize. So we have now really tokenized assets on the Centrifuge protocol that's reaching from private credit. Think of kind of consumer loans, auto loans, real estate, really to T-bills. And that is most likely one of the oldest and most simple products in the real world. So it's really suiting all of these products. The Centrifuge, I think, has its superpower is not only producing a token, an ERC20 investors can buy, but really creating also the infrastructure behind that token on chain. So coming back to, I think you mentioned already, digital native or digital twin, I think really Centrifuge is driving it in the direction of creating digital native assets which are still rooted in the real world and is able really to connect the asset in the real world and how it's financed and what it represents in crypto or on the blockchain as a token. And also one of the driving factors for that is Anemoy. I think we can tap into that later and why we started that in parallel last week. No, really, the underlying I'm talking about here is you have an asset in the real world, coming back to Taulia, an invoice. And no investor wants to directly finance an invoice that doesn't, depend on a blockchain or traditional finance. So typically what you do in traditional finance is you create a structure in the middle, which is kind of collecting the invoice, pooling those invoices, and then selling it to investors. In the past, it has happened very clunky. So typically you have someone who gives you a working capital line, as someone who is creating an SPV in the middle, and depending on supply and demand, you may use the working capital line in the middle and then sell more and less to participating investors through a note structure. If you remember, you might have heard of it, Quensel was deep in that business and has relied on Taulia technology back in the day. Why they failed was not Taulia. It was the other more fraudulent use cases they had kind of, pursued in parallel. But anyhow, that is what blockchain can make much, much more efficient. That's why a Franklin Templeton is talking about blockchain that comes to asset management and tokenization is 30,000 times more efficient than traditional finance. I do not know where they have the number coming from, but if you imagine that basically from I have an asset, put that asset itself, a single invoice on the blockchain, had the blockchain managing all these invoices, a pool of invoices, and had that distributed to investors, and that is all smart contracts, no human need to touch it anymore. I think you can imagine that it could be 30,000 times cheaper.
And where do we currently stand with regards to native issuance? Because so maybe a little bit to share how I got to know Centrifuge. I held a lecture actually at St. Gallen University and then discussed how DAI works, right? And that was at the height of the backing of RWAs by DAI, right? So that was in November 2023, where I think 50% of the outstanding DAI was actually collateralized by RWAs, so real-world assets, right? And centrifuges were just at the heart of this, right? So, but back then, and you already touched upon it, right? Those were private credit notes that were issued off-chain and then
T-bills.
represented, but still T-bills off-chain, right? And then represented as a NFT ultimately, and then represented as collateral for the DAI. So where do you currently see the industry going, and also where do you focus on? Is it still the, let's say, tokenization of off-chain securities to bring them on-chain, or do you already see a big trend in the direction of native issuance?
So I think how I see it is how finance has evolved in the past is direct investments. Then direct investment turns into what we call mutual funds. Mutual funds being actually wrapped by exchange traded structures, ETF and ETP. And that is actually adding layers of efficiency if it comes to accessibility, tradability, and liquidity. And blockchain is the next iteration. And I think if you look at traditional asset classes who will be most likely replaced by a token sooner and others later, I believe the latest innovation step in traditional finance will be replaced first by a token. What does it mean is we will soon see that bonds being issued as a token natively. The UK, the Chancellor is already discussing creating a gilt as a token, and then the token is the security. I think those rumors coming from the US, other countries, especially in Asia, you're in Singapore, talking about that, as well. And that would, of course, mean it's not only a token, but you basically have a gilt, so a government bond coming out as a paper version, or, the traditional product everyone knows, but also as a token. And then with a token, you can really create those automated processes, sell it, buy it, all on the blockchain using stable coins, etc. And really all the exchange traded products I have mentioned are basically most likely, I most like call it the next victim of blockchain, I guess. It's my bet, And then from there, it will really eat up eventually everything in finance, but that will most likely take years. I don't know how long it will take, But I think sooner or later, everything is a token. Completely agree. But surprisingly, actually, the latest and most innovative parts of of the traditional finance system will be killed first. And that's exactly why BlackRock, I think they have understood that, going so massively into tokenization.
Before we go in that, I wanna really make clear what I understood when you explained centrifuge inner working to me, and it took me 2 hours or so, and a lot of mails. you remember, because I think we talk about different things. So on the first hand, we tokenize something like an invoice, for example, or anything in supply chain finance or trade finance. This thing lives in the real world and is just tokenized as an NFT with all its attributes, like an art NFT. Yeah, you can add kind of attributes, so you can precisely digitalize all the attributes of this thing that you tokenized. But what Centrifuge does, it doesn't stop there. Yeah, most tokenization projects we hear of is exactly this one thing, and then you try to find investors for that one thing. So the one thing needs to be very, very big, otherwise it's not interesting and it costs a lot of money. The cool thing of Centrifuge, from my perspective, is pooling. So you pool together similar assets of any kind, yeah. So we will talk about T-bills a lot today, but it can be trade receivables or something like that, yeah. So the power of Centrifuge is pooling together these similar things, calculating something like NAV on chain, because you have all the data in these NFTs. So I think you're one of the very, very few, if not the only ones, who can actually really run the fund literally by smart contracts, because you have all the metadata that you need of all the singular elements inside the pool all the time, in real time, on chain, or at least 99% of all the data you need for that. And then your investor comes and puts money against the pool, not against the singular asset. That took a lot of time for me to understand. And I think nobody talks about that in the scene. So everybody talks about fractionalization, yeah? But you're doing the opposite. You pool together small stuff and make it interesting for investors. And that's, for me, that was my click moment. Am I right with that? Or do you see competitors in the market who are on a similar track like Centrifuge in that regard?
It's, I guess, our legacy. That's why Centrifuge is so unique, because we come really from the origination side as a founding team, this, the legacy in Taulia and process automation. And what we are building is really asset management for the on-chain era, which is ahead of us. Coming back to the invoice example, it sounds so great, but an invoice itself, if that is a token, then that is a game changer. And that was most likely, it will be a token sooner or later. And companies will talk through each other through the blockchain. And the blockchain will be the single source of truth between the business of two companies, whatever, But I think the first thing, and there still Centrifuge is very, very valuable, is basically build something like an ETF or a money market fund on chain. And even there, Centrifuge is very helpful, Maybe coming back to Anemoy, what that is and why we did that. Anemoy is a regulated asset manager using Centrifuge and other platforms to put as much of the process, as much of operations on chain, and helping also traditional asset managers to use that. So Anemoy is mostly, I think, a servicer, a regulated servicer using blockchain technology for traditional finance asset managers to adopting the technology. And the first thing we built, obviously, was a T-bill fund. And that is exactly the same procedure, You invest and hold and sell T-bills, so a single government bond, short-term US Treasuries. Every of these treasuries is a single NFT with its own parameters like maturity, purchase price, when you sell it. That together is automatically creating the value of the fund called net asset value. And then you can distribute that to investors in form of a token. And the structure we have used there was one of the first, I think, regulatory structures where the token itself has value. Most of the T-bill fund out there, the token is a digital twin. But you need to sign the paperwork, usually in digital form, DocuSign, whatsoever, in parallel. And that gives you basically the right on the underlying and the right as an investor. And the token is acting as an accounting unit for that right. But the token solely itself has no meaning other than that accounting unit. But out of the British Virgin Islands, Liechtenstein is going in the same direction. I think Europe is MiCA as well, but really facilitating that for funds. BVI was the first jurisdiction who allowed that the token itself is the fund share. So the token itself is the security, and that is a game changer, and also exactly the reason why when we launched last year, December, BlackRock is using exactly the same structure for the BUIDL token. The BUIDL token is a professional BVI fund like the Anemoy T-bill fund. The BUIDL token itself is the fund share. That is kind of, the most likely cleanest structure to give a token actually an on-chain value, And it's also by Moody's, for example, rated us AA. So, of course, T-bills are AAA, then they need to get a little lower, but as close as possible. So we were the first really on-chain fund and the first token who got a AA Moody's rating. That is kind of, an expression of that. And then from there, really visit token exploring more distribution models, So like BUIDL does it, we did it as well. We launched a Morpho market on Base, for example. They can use the token itself as collateral, working with market makers for our Anemoy liquidity network, where basically market makers give liquidity on top of the T+1 settlement for a T-bill, where, I get a redemption order. I need to sell in the real world my T-bill. The T-bill sale is settled T+1. So the next day, so an investor basically need to wait at least a day for the money. This, the Anemoy liquidity network, you have instant redemptions. You can really kind of sell your T-bill token back to the fund and immediately get your stablecoins back.
So just to summarize what you've just said, also with regards to native issuance of those T-bills and tokenized versions of those T-bills, right? Right now, there are not really natively issued T-bills, right?
Zero.
So if I understood you exactly, so if I understood you correctly, what you guys are basically doing are replicating all the the life cycle events of that bill as a token and as an NFT. That then is the foundation for another token, which is the fund token that calculates the net asset value, so the NAV, automatically from all the features that the underlying NFT tokens, which represent the T-bills, actually have, right? And therefore, you automate the whole funds life cycle processes ultimately because, the NFTs are programmed in the sense that they represent exactly what happens off-chain without needing, let's say, for now, a native issuance of that particular T-bill.
100%. I couldn't have described it better. I think that's also why Anemoy doesn't need what others call a proof of existence or an attestation because it is built in. So our fund administrator is directly pricing the NFTs, and every NFT is a real-time representation of the fund holdings. So every investor can see, I have a fund share in a pool of NFTs, and these NFTs are T-bills, and I exactly see really in the Centrifuge app, in the Anemoy pool, how many T-bills being held at any time and what revenue every single T-bill is generating, and how then that together is actually my return as a shareholder of the fund holding all these T-bills.
And are we already at market standard with regards to that, or is that something that only Centrifuge has?
That structure has only the Anemoy pool. This is Centrifuge underlying. So that is, I think, what I would most likely call the forefront of T-bill tokenization. I think everyone else, you need an attestation, and you do not really have the transparency what's behind it. You do not even know if it's maybe a mixture of T-bills, repos, whatsoever, if it is a tokenized money market fund. So you do not really 100% know if the underlying there, and need to kind of, a lot of those funds do that, have a daily attestation that they upload a PDF and make it available from an administrator or a trustee, so on. We don't need that. So it's really something where you can really connect what is still real world to what is the token, and investors have full transparency through the entire life cycle of an asset and how the real world is connected with the blockchain.
Absolutely. So in my eyes, most of the competitors are actually managing the fund more or less off-chain classically, and they just create kind of a token as an interface on-chain to have an on-chain representation. So it looks to me like 10-20% of the effort or of the solution is actually running on-chain. Whereas with your approach, I think 80% of the whole stuff is actually running on-chain. When we look into your diagrams, it's still complex. So I had a look into how the liquid treasury fund by Anemoy is actually structured. So there's still some overheads. There are still fund managers who have to do a lot of work to bring in new short-running T-bills into the system. So maybe for the listeners, these are short-running T-bills that run up to 3 months, 4 months at the moment. Am I right?
Exactly. So the weighted average duration is below 45 days. The T-bills itself is anyway a short-term US Treasury, so up to 52 weeks, but we only invest in T-bills with a remaining maturity of 3 months or less to kind of actually keep the duration risk of holding a T-bill as short as possible. It's really a short-term liquidity instrument.
Can you take us through the life cycle of such a T-bill? So I think the dynamics are quite interesting. We always take it for a given that if we want to invest in such a fund, that there's always enough liquidity, but someone in the background needs to look after that, needs to obviously manage that. So take us through the dynamics. What happens when a T-bill matures? What happens when you introduce new ones into the fund? I think that helps a lot to understand the inner workings.
So absolutely, U.S. Treasuries are issued by the Department of U.S. Treasuries. So the Treasury Department, you have, as a U.S. person, the ability to directly invest to it. You just go to treasurydirect.gov, connect you with your social security number and your bank account, and you can buy also as a private person U.S. Treasuries, including T-bills. Treasuries being splitted in bills, notes, and bonds. And that is just depending on the maturity. Everything below a year is basically a bill. A bill is a so-called zero coupon, so it doesn't pay interest. It actually, you buy it for a price with a guaranteed return from the U.S. Treasury Department at maturity after 4 weeks, 8 weeks, 16 weeks, whatever the duration of a T-bill is, for $100. So you buy every T-bill for less than $100 and get it when it matures, get back $100. And the difference between the purchase price, let's say $99, if it is a very short running T-bill, and the $100 you get back, this $1 is basically your return. It's a zero coupon. And there is, of course, trading infrastructure. So every prime broker in the world can buy and sell T-bills, and that's also what they are using. So Anemoy is a regulated fund, has a custodian who is holding those T-bills in custody, have a broker who is buying and selling our orders and executing it, and is directly transferring it into the custody account and out of the custody account, and fund admin who is running these processes and do the accounting, and a fund auditor auditing it. And that is really the infrastructure you really need to be a regulated fund. And all of these players need to be licensed as a custodian, as a broker-dealer, as an administrator, as an auditor, and they all do their work on our instruction, but also supervise that I cannot steal any fund, and that it's all proper and valued, and kind of, the accounting is right. And the fund administrator is directly, again, updating the blockchain. That's why the blockchain is a real representation of what's happening in the real world. Life cycle of a T-bill is really, I get an investor in. So the investor is going through KYC AML, is connecting its wallet. The wallet is allow listed, is investing stablecoins, USDC, for example, or DAI, or now its new version, USDS. That stablecoin is transferred into Fiat, goes to the broker. The broker gets instructed to buy a T-bill. The T-bill is transferred into the custody account, T+1, starting to accrue interest. And that interest is directly through the fund administrator doing the counting updated in the NFT representation. So new NFT for buying a T-bill, burning an NFT, but of course, blockchain is immutable. You still see that in the accounting, and a T-bill is sold. And using the Centrifuge app, looking in the Anemoy pool, you really see monthly balance sheets. You see what is actually behind the token price in real time, what was in the past the T-bill holding, what the current T-bill holding, what was the return of every single T-bill, when it was bought, when it was sold, when it matured, etc. And redemption is exactly the same. At any time, an investor can actually lock in a redemption request using the Anemoy app, giving back its T-bill tokens. The T-bill tokens will be locked. The redemption order needs to be executed. So the traditional setup is really, I instruct the broker-dealer to sell T-bills. The T-bills will be sold. The US dollars will be transferred into stablecoin. The stablecoin will be paid back, actually to pay back this single NFT or those NFTs representing the T-bill. So the NFTs will rather shrink or being entirely paid back and burned. And then this money is distributed to the investors with the redemption request. The Anemoy liquidity network, you can get back your money immediately for a fee a market maker is charging, where a market maker is actually stepping in, taking over the T-bill, ongoing T-bill redemption and the claim on that. And the investor gets immediately its USDC or whatever stablecoin back. So they can already see, hey, how blockchain is able actually to improve, even on small scale, the investor demand. And I think, hey, everyone on the blockchain really has investment needs where they need immediate liquidity. You can invest and redeem and manage all your money on the blockchain 365/7 every block. And that is what also I think traditional products to be successful in the blockchain world step by step need to offer,
So we have this 24/7 real-time behavior, but in the end, we still fake it a bit. We are market makers because there is still real-world fund T-bill management happening nowadays, which might go away when the T-bill issuances get more digitalized in the future. Or how do you see that evolve in the future?
I think these market structures we're having in a traditional world, so secondary markets for T-bill, for example, where we have market makers, where we have broker-dealers. So market maker is nothing the blockchain has invented. They are out there since decades in the traditional world. These market structures, and I see that happening before we directly tokenize invoices and all the cool shit we've been talking about before. I think these market structures moving on the blockchain in a next step. And that will really disrupt finance, because then you can go from T+1 to T+0, from T+0 to T+1 second. And that is something which we will most likely see in the next few years. Maybe even already starting next year, then maybe with an experiment, something like the UK, the US, maybe even a European country or an Asian country is directly issuing a government bond on the blockchain. And then if you have a native token, also those market structures just follow automatically, because then there will also be a market maker from the traditional world who would like to trade it on chain, and it's coming on, And so it's also, you see actually, hey, the regulated world on the blockchain needs permissioned rails, because you need a playground everyone can use, even if a single use case like a single token transfer is permissioned. It's may only in secondary market where it's only a broker-dealer who can interact with a fund, or a direct investor who can interact with the fund, but actually everyone on a secondary market can trade.
Very interesting. So you see big changes for market makers ahead. So they will be also forced to learn about this on-chain world.
Absolutely. I think, hey, I mentioned exchange-traded products before and exchange-traded funds before. And I see that structure really also evolving onto the blockchain with all its deep structures, like, authorize participants, market makers, etc. And we will see that most likely starting sooner than later. So maybe mentioning why we do Anemoy. Anemoy is really, I think, the facilitator for that movement, and how we actually think through Anemoy infrastructure like Centrifuge can plug in. But there's many more. I mentioned already Morpho, Base, etc. So there will not be a single protocol. There will be multitudes of protocols and thousands of players, most likely even more than we have today, because that infrastructure is scaling. What we've been successfully able to close as Anemoy was a first partnership for improving the T-bill fund, but also launching many more products with Janice Henderson. It's maybe in Europe, Germany, a not very well-known asset manager. It's a mid-sized asset manager, has 380 billion under management, but is really one of the leaders, if not the market leader, if it comes to actually ETF products for CLOs. And one of the things we would like to pursue is really building ETF structures on-chain. So it's not a token who is representing an ETF. So you have a fund buying and selling an exchange-traded fund share and then redistributing it as a token. No, really building the entire ETF structure on the blockchain. And I think those use cases will really kind of most likely earn the cost efficiency potential blockchain has. That is one thing. But the second thing is really, and that is what a lot of people really underestimate, but I think the real driver is investor utility, kind of, instant redeem. Do more with the token, kind of coming back to early days. I experienced myself, Stefan, you too, e-commerce emerging in the early 90s in Amazon in 93, ringing the clock, the first bell, the bell the first time for selling the first book. And that book buyers, consumers didn't buy a book online because it was a great user experience. No, they did it because they could buy any book in any language on a website. And there was no bookstore able to do that. And that was actually why the first users used Amazon, not why it was cheaper or better. That all these things came later. But the first use case was really, I can do things I couldn't do before. I could get something I couldn't get before. And that is exactly where the blockchain built in the first place. And then from there, I think grow the ecosystem.
Can we maybe spend a couple of times also on the underlying infrastructure? So we are talking about what can be done on blockchains and to basically automate whole life cycles of underlying assets, but then also funds. Where do you currently see the technology? So you mentioned that Centrifuge has its own blockchain. Can you maybe spend a little bit time on that, and where do you see those sophisticated use cases being able to be built? Is it possible on layer ones like Ethereum? Do you need a layer 2 for that? Is there restriction even there, or why did you decide ultimately to build your own blockchain?
So I think we will see a multiverse of blockchains in the future, and it will be a mixture of a few layer ones. There's most likely an endless number of layer 2s, and the layer 2s will, at least a part of them, bigger and smaller, will evolve in what I would call an app chain. And Centrifuge is a typical app chain. You have one use case. That use case actually needs to be run as efficient as possible, like asset management on chain. And that is best on a most likely blockchain, which is on purpose built for that use case, an app chain, where basically you have an app with its underlying blockchain. The second thing is really security and actually secure value transfer and value storage. And that is not where an app chain with minimized transaction fees is doing a great job. I think that is really something where bigger L2s, like, I mentioned already in Arbitrum, a base, Ethereum will play a role. And as I think, as more you hold, as more you invest, as higher the transaction value, you most likely go also for the value, the layer you think is protecting you efficiently and sufficiently. And that's why I also think layer ones will not go away, but they will only transact not on scale, but on volume. And that is also how we build Centrifuge. Centrifuge has an asset management layer. We call it asset pool that is living on the Centrifuge chain. And that is connected to what we call liquidity pools. And they can live on any EVM chain. So Ethereum, we have investors on Ethereum. If you take the T-bill pool, perfect. Assets being managed. So these NFTs living on our app chain in an asset pool, and that is very efficiently low transaction fees managed on the Centrifuge chain. And then the price feed is really distributed through bridging custom messages, so no token transfers, to the liquidity pools on an EVM chain like an Ethereum, an Arbitrum, a Base, a Celo, etc., where investors then hold the token and can invest in the token using a stablecoin. And how we select actually chains, go for chains where we see an investor ecosystem and a stablecoin ecosystem, and one comes with the other, so that you can actually invest natively in a stablecoin on that ecosystem, and we do not need to bridge any token. So it's really one asset pool connected to a lot of arbitrary number of liquidity pools on an arbitrary number of chains in the future. That's how we see that as Centrifuge.
Here I have an important question, because when I talk to asset managers, they all look after wholesale CBDC because more secure, no counterparty risk when compared to stablecoins. How do you see that evolve? Because I don't expect that any central bank of this world will issue a wholesale CBDC on such a EVM compatible public blockchain soon. But how do you see that competition, especially if we talk about large volumes of money?
I think it depends on regulation. So MiCA is, as usual, what European does, a step in the right direction, but may going too far, is my personal opinion. I can evolve that a little later. Coming back to CBDCs, most likely Bank of China could be, one of the first really issuing a national stablecoin, where the stablecoin itself is fiat and not a fiat representation, or needs to be pegged at fiat. But most of the models we are seeing, everything which is actually gaining traction, also all these MiCA compliant stablecoins, which will we see soon, or with EuroC and a few others, we have already a few, they will be fiat backed. You say, hey, I actually would like to have a stablecoin if I think it's really stable, which is pegged to a collateral. And we see most likely two models. One is really fiat pegged. Circle is a great example. And the other one is really blockchain collateral backed. And there most likely Maker is the prominent example. With DAI, now called Sky and USDS, or kind of, if they're just migrating from one to the other. And these are the models, honestly, I see succeeding. I didn't really see, and CBDCs finally, of course, will do as well, because you trust that a national bank or a central bank as an issuer of a native token does exactly the same good job as for fiat. And if it is anyway fiat pegged, hey, what is the difference? Anyhow, so if the Federal Reserve or the ECB or whoever is issuing a token, I see that succeeding too. And then we have all these kind of algorithmic stable coins. I even doubt you should call it a stable coin. It's so that I think calling it another version of a meme coin is maybe better. And then you either believe in it or not. And it's actually most likely creating the same incentives and the same issues. So it's what it is. We have seen it failing so far. And maybe there is some clever guy, woman, no man in the future who can actually build a monetary system on chain, which works for its own. Maybe eventually, if everything is a token, yes, but most likely not in the next 10, 20 years.
But you mentioned MakerDAO, which is now called Sky, for several times. There's one cool project that we can't close this podcast episode without mentioning that. So they called it Grand Prix. So they asked for, I think, $1 billion of real world assets on chain to back their stable coin. And you with Anemoy participated in a bid. Actually, I really invite every listener to look at the site of MakerDAO. This is a forum. This looks very ugly, actually. But all of the big asset managers of the world found their way in there and applied officially out in the open with 30 pages of PDF. So I think if someone wants to get an overview of what's going on in that market, this is the place to look. But maybe from an expert like you, maybe you can give us the motivation. Why is MakerDAO doing that, and also the response from your end? Why did you go in there?
So why Maker is doing it, I think they would like to have a more diversified collateral base, which is not only crypto but also real-world assets, and actually is protecting their stablecoin against the ups and downs and the volatility of crypto. That makes total sense and has proven to work. We built this Maker, actually a structure for their PSM and T-bills, which was great, but not really transparent. Maybe you've heard of Clydesdale, Andromeda, those sub-DAOs managing the T-bills in the past. And most of Manuel, what you have mentioned, as real-world asset collaterals at Maker went through those structures. And they would really like to have that in a more transparent structure managed by Spark, one of these sub-DAOs. And that's also why this tokenization Grand Prix. Why everyone is participating. I think when they started the Grand Prix, it was, and I think it still is, the biggest single real-world asset tokenization opportunity in the market. $1 billion for T-bill tokenizations. That's also why everyone who is, I think, more on the DeFi side of things, like Centrifuge and Anemoy, is participating, but also everyone in TradFi who is approaching tokenization is participating. And as you mentioned, if you would like to get an overview of who does what in real-world assets, just go to the Sky Forum, ex-Maker Forum, check out actually the applications, and you're having great overview who does what and what they are approaching. So a Franklin Templeton, a Fidelity, an SG Forge, BlackRock, obviously, everyone, who did tokenization in the past in traditional finance also submitted a bid. Fun fact for us was, of course, kind of leveraging our infrastructure where we are unique, that we can give Maker transparency on the underlying, number one, and that we mentioned already in 2019 had the first Maker balls for other use cases, very familiar with the structure and how to integrate that and make that a real on-chain experience, where most of the proposals basically say, hey, we mint an ERC20 token, put that into a Maker vault, and you need to believe us or the infrastructure we had built off-chain that the token is representing a real value, a real T-bill holding. And we can really come closer to make it trustless, but with a real-world use case being involved, you most likely can rather minimize trust than make it entirely trustless. But anyhow, I think that goes already a step further. That's why I think we actually have a differentiator to others. And the second is most likely that Centrifuge is a platform. What does it mean? Every asset can run on or actually being tokenized through that platform. And T-bills is only the first step. Maker, other stable coins, all these investors, they would like to have also a more diversified real-world asset experience, so not only T-bills, but also T-bill yields decreasing. You would like to most likely diversify the portfolio as well. Kind of that comes together with our plan on reinventing ETFs on-chain. And then with those, immediate liquid products is what a stablecoin needs, but most likely more interesting yield opportunities, helping organizations like Maker to build a diversified real-world asset portfolio. So it's funny enough, I think, with all these ideas, we submitted a great application. And as BlackRock has copied our BVI-based structure. Fun fact, if you're interested, I think they copied our application too. So if you download the Centrifuge Anemoy PDF, which is, I think, a few days older than the BlackRock PDF, there are similarities.
I find it so mind-boggling and so interesting. So, I'm coming out of cash management and traditional banking, and the whole discussion is rather about private blockchains and, public blockchains with the new Basel requirements cannot be really touched and so forth. But the asset management industry is on a completely different track, right? Because they are not bound by these Basel regulations, by these Basel rules. And apparently now every large buy-side actor is actually now looking into this area. And as you said, is bidding now for this Grand Prix. Maybe any views on this before we wrap things up? I find this incredibly impressive. These are like two universes that so far don't really talk to each other. Yeah?
Absolutely. I think it's two universes where you can already see it somehow emerging. One of the biggest and the biggest asset manager of the world, speaking to a DAO, discuss use cases with a DAO, create use cases on public blockchains. Amazing, and that was something, if you look back 2 years ago, impossible. And that is actually already the momentum and the change. You're already seeing it happening, where I actually believe, just quoting BlackRock here, where they say, as a podcast, I think, where the digital asset manager got asked why are they doing it and how they actually see the future, with mentioning 2030 as a date. He replied kind of, I think we actually do that to have everything tokenized by 2030. That's why we are doing it. If it doesn't work, nothing will be tokenized. So they are really believing, hey, by 2030, either all our products are a token or none. And we need to actually now, in the next 2 years, figure out, is it one or the other? More likely, I guess, the token. That's why we are here, I guess.
Yeah, and now Manuel has an idea why I wanted to bring you on the podcast. I think my idea came true. Thank you very much, Martin, for these deep insights. I think it's very, very complicated. Again, I had to wrap my head around how Centrifuge worked several times. So, dear listeners, if you didn't understand everything we were talking about, it's not your fault. It's really complicated, and I think we need to work on some visuals still. Like in our last discussion, I think there are still some graphics missing to really, really explain the beauty of that solution. I'm a visual guy. It really helps me a lot to see how things are structured and are flowing. But I hope with our words we brought some paint on the wall to make more and more people understand where all these advantages are actually coming from. Because my problem in the field is sometimes that all these advantages we've been talking about are thrown at the wall, but then the solutions that these people actually come up with are maybe 10% of that what you need to do in order to reap the benefits that you were actually talking about. So many times you then use very limited solutions which have a bit of blockchain in there, but actually that's not what the advantage of the benefits need to do. So I think it's not getting a bit wet. You need to sometimes really jump into the cold water, like you obviously did. Yeah, and that I hope we brought that across a bit with this podcast episode. Thank you very much, Martin.
Likewise, thank you for having me.
Thanks, and I hope to repeat that maybe in a year to see where the industry then stands. I expect big leaps.
Yeah, thank you. I think it cannot wait a year. You most likely need at least, have it every 6 months, if not every third. Every
cool. We will watch you. We will watch how this evolves.
Yeah, thank you.
Thank you.
Thank you very much. Bye-bye.
Achtung, Disclaimer. Die Inhalte spiegeln die private Meinung der Hosts wider, dienen ausschließlich der allgemeinen Information und stellen keine Anlageberatung oder Kaufempfehlung dar. Es gilt, do your own research, informiert euch, bevor ihr Investments tätigt. Das alles findet ihr auch auf unserer Website unter www.bfrr.de/disclaimer.